Reading price charts, bar by bar. The technical analysis of price action for the serious trader. Chapter 3, Trends. Table of contents. Two legs. Signs of strength. Common trend patterns. Trend from the open. Reversal day. Trend resumption day. Trending trading range days. Tight channels and spike in channel, bull or bear. Stairs, broad channel trend. Two legs. Two-leg moves can happen in any time frame, trend, pullback, or reversal. Once there is a break of a trend line, this creates the new leg. Two-leg moves can be complex, meaning a whip trend setup can have two legs, and also the pullback within that can have two legs. Here's a bullish two legs. So we have a strong breakout, a trend line break with this bear bar, and then I project it and it's met. Here's another bullish breakout. I project it from the bottom of the breakout to the top of this candle, and that's because that's where I see a strong trend line break, from right here to here. So from the bottom of the strong candle to right before the trend line break, I pulled bottom of the pullback and it was met, the projected move of this big leg here. Two legs bearish. I start from the top and I pull to the bottom, and this bar is a trend line break, a steep trend line break. So I project it from the top of the pullback and it's met. Here's another bearish leg. I start from the top of the breakout and pull down, and then these two bull bars make a trend line break, so that becomes the top of the pullback and it's projected down and met here. Two legs, complex bullish. So these are the same charts, but I wanted you guys to see it, how I pulled, because this looks it looks complex. So the first two legs is the biggest two legs, from the bottom of this bar to the top of this bar, because this leg is a trend line break. I project to the bottom of the pullback, and you can see that was met here. So leg one, pullback, leg two. Now within this range, there's multiple legs. Here's a leg. The red line starts from the top of the bear leg to the bottom to the high of the pullback, because that's a trend line break and it's projected down. So I projected the high here to the bottom of this wick. This leg was broken. The trend line was broken by the bulls, and I projected from the top of the pullback and it's met down here. Now, if you could bring your eyes to the orange two-legged pullback, I pull from the bottom of this bar to the top and then to the trend line break. This bear bar is a trend line break on a smaller time frame, so I pull from here to here and I set it here, right there, and it's met at the top by the tick to the tick. Within this bullish leg, there's a bull pullback, a bull two-legged move, and now here's a bearish two-legged move within a two-legged move. So this is a two-legged move, this is a two-legged move, and now bring your eyes right here. This green line, I started at the top of the bull. This wick is a pullback, so that's a trend line break. So that's where I put the top of the two-legged move, and it's met down here, and then the market goes. This is a complex two-legged pullback for the bulls, multiple two legs within the major two legs. Two legs, complex, bearish. Same chart again. The first big two-legged move I pulled from the top here, so the blue line to the bottom to the top of the pullback, the trend line break. The top here to the bottom to the top here, and this bullish move is a trend line break, and that also has its own two legs. However, this first leg of the big two-legged move also has two legs within it. I'm looking at the green lines now. I pull from the top here to the bottom here. This bull bar is a trend line break, so that's where the top of the pullback goes. And it's met on this candle, so two legs. Leg one, pullback, leg two. And then the first one we looked at was leg one, pullback, leg two. Now if we can look at the red lines, it's a two-legged pullback within the two-leg move. So I start with the bottom of the bull candle to the top of the bull candle, trend line break, pull, set it there, and the target is not met. This is interesting because the context to take this trade isn't good. We're in a strong downtrend. So if the context isn't good, it could become a failure, and this ended up being a two-bar reversal, and it failed to be met. So just because you see a move that looks like it can have a second leg doesn't mean it will have a second leg. Things fail all the time in the stock market. The last leg is this orange leg. and it's climactic, but if we think about trend line breaks, here's a strong breakout to the top of the orange line to the bottom of this, and then this wick and that wick creates a trend line break, which is a pullback. And you can see how the bars are shrinking, so it's due for a pullback after a climactic move. I put it to the top, and it's met right at the bottom of this candle. The two-legged moves are great, and you can take counter trend scalps, but be ready for them to fail. It's always better to trade with the trend. Signs of strength. It's easy to tell at the end of a day whether or not we had a trend. The goal is to find characteristics that identify a trend early on. Trend characteristics. Big gap openings with follow through. Pullbacks are small. Trend bars are orderly. As the trend progresses, no two consecutive closes on the opposite side of the EMA. Here's a big gap up with follow through. It's a 30-point gap up that's breaking out of the EMA, and then the market channels. All the charts are going to be the same bull trend, so we can understand it better. So the gap up was down here, and we get really good follow through, and the bears pullbacks are weak. They're not getting follow through, so the market's buying above the EMA. Above the gap up and above the EMA. Pullbacks become a bull flag. Here we can see this pullback is hard to trade for the bears, and they find support on the EMA, and it breaks out. The bear bars are very shallow, and they represent pullbacks. The trend bars are orderly. Here we can see another spike. It doesn't look too climactic, and they're all about the same size. Here we can see more spikes. These two bars can equal this bar, and that bar looks about the same as that bar, and so on. These bars look about the same. No two consecutive closes on the opposite side of the EMA. So bears can't close below the EMA. The EMA is acting as support. When they came into the EMA, bulls bought the average price. They've been trending for a while, so they want a chance to buy the average price, and it goes higher. Big gap down with follow through. So now this is the bearish trend. Here we have a 17-point gap down that's breaking through two EMAs with follow through. One thing I wanted to point out is the previous gap up was 38 points, and this is 17, and I used the word big gap in both of them. Big gap is relative to where the market's at. So we would look at the prior days. If we're having 10, 15-point ranges, 17 is big. If we're having 20, 25-point ranges, 38 would be big. So for the bears, this could be a big gap down, 17 points with continuation. The pullbacks are small. The EMA is acting as resistance, and bull flags are becoming bear flags. This is a double top bear flag right on the EMA. Trend bars are orderly. Nothing looks too climactic, and the bear bars are orderly. Here we can see when the bars got a little too climactic, the market pulled back, and then we have another breakout that is orderly, and it kept channeling lower. No two consecutive closes on the opposite side of the EMA. Bulls can't close above the EMA. As soon as they got to it, the bears saw this as an opportunity to discount at the average or short at the average price. They took it, and the market went lower. Common trend patterns. Get familiar with the open. If you see a pattern emerging, trade it. If you don't, it could become a range day. Only take with trend entries. One good with trend swing can equal up to 10 scalps. All counter trend entries should be scalps. If you are taking more than 2 or 3 counter trend entries, you are missing the main trend. This was a very short section, and the following sections will build upon these. Trend from the open. When there is a big gap, the market can trend from the open. The direction of the trend doesn't have to be in the direction of the gap. A gap up can have a continuation, or it can reverse. A gap down can have a continuation, or it can reverse. Entering with the trend can be scary, buying highs in a bull or shorting lows in a bear. Traders should trade with a small portion and add on if it goes in their favor. Here's a gap up plus continuation. We see the market is range bound. We have a gap up and have 3 huge bull bars with a small pullback. So these are signs for a trend. The bulls are keeping gaps open. It could be scary to buy this high, thinking that the market has to reverse, but the bulls are showing momentum right off the open. Here's a gap up plus a reversal. This is a really big gap up with bad follow through. The first two bars are bear bars, and that's not good in a bull trend. The bulls tried to defend themselves, but it reversed into a two-legged move. Breakout and continuation. Here's a gap down plus continuation. Bears get a good gap down through the EMA with follow through, and then it ended up becoming a pullback, and they traded lower. They were unable to get multiple closes above the EMA. Here's a gap down plus a reversal. The previous day had strong bull legs, but the market opened with a gap down. The bulls saw this as a discount and a retest, so it started to reverse. They bought here, pull back. This is a higher low, and they're closing bear gaps here. So the bulls are showing strength. They trend higher. Reversal day. Some of the strongest trends can start in the middle of the day. The open can be range bound, then a strong breakout midday. On strong trend days, enter as soon as you can and expect the market to move far in the trend direction. Here's a bullish midday reversal. We can see the market opens up range bound and bears get the breakout, but it's really bad follow through. Bulls pick up around 10 a.m. Pacific Standard, which is the midday, and they break out and trend for the rest of the day. Here's a bearish midday reversal. It looks like bulls are owning the day, but around the midday, 10 a.m., bears get a wedge top, a double top, and a lower high, showing that the market is transitioning into bearish. It could be a bearish trend down to here, but it ended up being a really strong trend, and they made a new low at the end of the day. Trend resumption day. Trend resumption days often have a trend from the open. After the trend, the market can go sideways for 2 to 3 hours. Once the market has been range bound, wait for a breakout in the direction of the trend from the open. Sometimes we can see a pattern within the range bound price action. It could be a double top, double bottom, or any type of reversal pattern. Bullish trend resumption day. Here we can see a trend from open. Bulls are keeping their gaps open, and then the market goes range bound. The market goes range bound for 2 hours and 45 minutes, starting here and ending here, this arrow. Here, this becomes a double bottom bull flag, or it could be a wedge bottom with these three pushes, and there's a breakout, and the market trends for the rest of the day. Here's a bearish trend resumption day. We can see a strong gap down. The market trends for about an hour, and then it goes range bound even longer for 2 hours and 10 minutes. I started the range from this bar because bulls started to find support, and then bears broke out here, so that's where I ended the time. Both these times are about 2 to 3 hours long, and then they lead to a trend at the end of the day. Here's the breakout, and there's the wedge top, the pattern within the range that helps us get short. Trending trading range days. Trending trading range days are made up of ranges that slightly trend more in one direction. These days should be treated like trading range days and traded from the extremes. Often the price action goes sideways enough to take counter trend trades. This is unlike normal trend days where the trader should only take with trend entries. Bullish trending trading range day. Here we can see a lot of back and forth price action, but the bulls ultimately were making new highs. They had 3 pushes. You could buy the low and sell out at the EMA and short the EMA and make money. And then you could buy your position and make money going long and short back into the EMA. So there's a lot of two-sided trading going on, but bulls are making new highs until end of day. Bearish trending trading range day. Here the bears get a strong breakout, but there's a lot of bullish price action in the earlier session, the morning session. So we can see bulls are already buying lows and they're making scalps within to the EMA. Here they make about 10 points and get 2 legs. So you could short or buy long. If you're going to buy long on counter trends, you want to scalp out and trade from the extremes in both situations. Tight channels and spiking channel, bull or bear. The strongest type of channel is a tight channel that starts after a spike. A spike is a strong move in one direction. These channels often trap counter-trend traders into a losing trade. The trend looks like it's always going to reverse, but goes much further than expected. Only look to take with trend trades. Bullish spike and channel. Here we can see multiple spikes showing bullish momentum. Bears are unable to close them, so the trend is staying open. And then after a spike is the channel phase. We have multiple spikes, channels, and more spikes. It would be very hard for you to make money shorting these. You have to scalp out very fast. The EMA got touched once if that was going to be your target for a counter trend trade. So it's better to trade with the trend and you can make a lot of money adding into your position. Bears spike and channel. Here we can see multiple spikes, and the spikes are breaking out under the EMA in this range here, and then they channel. This could be seen as profit taking, and bulls almost made money. They touched the EMA once and that was it. So unless you can sniper this one bull leg, it is going to be very hard for bulls to make money, and they're going to get trapped, adding to the selling pressure. They'll buy here, stop here. Bears get short where the bull stops are at, and bears make money. It's a bearish spiking channel. It's better to trade in the direction of the trend. Stairs, broad channel trend. When the market has 3 or more trending swings in one direction, this can look like a set of stairs. This shows that both sides are trading, but one side is slightly stronger. As the swings continue, the momentum becomes weaker. Eventually, the counter trend traders will get a channel line break and retest. Here's a bullish broad channel trend. You can see it's bullish, but it's broad. Bears made money shorting this top, they made money shorting this top, they made money shorting this top, and they made money shorting this top. This is where we see the break and retest. Here is the channel line break, and this is the retest, and that creates a lower high for the bears, and they get the break out to the downside. Bearish broad channel trend. Here is the same thing. It looks like a set of stairs, and bulls are making money buying every new low. So they would wait for the bears to make a new low. They buy some here, buy more, and make money scalping out at the 50% level. Both sides can repeatedly do what they're doing until the momentum changes. And here we have a double bottom, which shows a channel line break and retest. This is bullish price action late in a bear trend and a breakout above the EMA. The momentum is getting weaker and weaker and weaker to the point where they can't make a new low. Bulls will see that as an opportunity. This is the end of chapter 3. Please leave any questions in the comments and I will try my best to answer them. Thank you for your time, and if you learned something, please consider subscribing.